We are starting to see the signs of a potential recovery right across the market, and Tom Lee is saying that he right now is a buyer of stocks. The popular CNBC analyst is saying that a lot of bad news has already been priced into the wider market, and in fact he goes on to say that there has been a lot of downside hedging just in the last week, and he says the odds of the 10 best days coming very soon are incredibly high, given the market is very oversold and pessimistic, meaning a potential very sizable rally is right around the corner. Investors, however, right now are still very worried, still sitting in the extreme fear, meaning sentiment is very bearish, and probably no surprises, you can forgive that sentiment given the fact over the last 5 days we are still seeing the market in a very poor position. Nvidia down over 10%, the same with Broadcom, and that does seem to be the case right across the majority of sectors. Now, we did get some ramping up of global tensions. In fact, China said they are ready for any type of war with the US, as they are starting to ponder on how to retaliate to the tariffs that Donald Trump has put in place. And we also note that the Canadian PM has hit out, calling these tariffs very dumb, as Trump has warned further hikes could be on the way. Now, today we're covering 6 growth stocks with some very strong potentials. The first one is Arista Networks, which designs and sells networking equipment primarily for data centers, cloud computing, and high-performance computing environments. They specialize in high-speed Ethernet switches and software-driven network solutions. Their extensible operating system, EOS, also provides automation, security, and analytics for efficient network management, and Arista serve large enterprises, cloud providers, as well as financial institutions. Now, if we take a look at the company, first thing we want to point out is that Quant give this a strong buy, and we get a double buy signal from both Seeking Alpha as well as Wall Street, with the company trading in the lower end of the 52-week range. Having said that, the company is up 25% over the last year, and year to date it's actually been hammered down 21%. Longer term shareholders over the last 10 years would have still massively outperformed the S&P, up 1,820%. We also get to see green right across the board, meaning over the next 4 quarters they are expecting growth to the earnings per share on a year-on-year comparative, and over the last 4 quarters they have outperformed analyst targets, 100% track record, meaning we do have faith they can hit their 2025 December EPS target of $2.50, and thereby the company is now trading on a forward valuation of 35.2. Now, in terms of the actual valuation grade, they get a C-. No surprise then that they do trade at a premium to the overall sector median. In fact, if you are buying this company right now, you're paying a 55% premium, but in terms of their own 5-year average, they're not that far off. In fact, they're only sitting around 1.6% higher, and that is something noted when we do look at the vast majority of valuation metrics. Arista Networks does trade at a significant premium to the overall market. In terms of growth, now whilst they do get a C+, year-on-year revenue as well as the next 12 months anticipated to be at the 19% point, which is well above the sector at the mid-single digit, and actually not far off their own 5-year at 23 and 19% respectively. In terms of their earnings per share, they are expected to grow this 19% year-on-year over the next 3 to 5 years, which is above the sector comparative at 14.5%, but also above their own 5-year at 17.1%. If we then take a look at their profitability, looking strong at an A+, gross margin 64%, above the sector at 50%, above their own 5-year at 63%, and bottom line, that is a very high bottom line margin of 41%, so no surprises, well above the sector at 4%, but also well above their own 5-year at 32%, meaning we are seeing efficiencies from this company. Remember, on this channel, a high quality company criteria is not just increasing revenues like we have seen from Anet, but also a company that does improve their margins over time, something we can clearly see. Their cash from operations also significantly high at $3.7 billion, well above the sector at $105 million, but also well above their own 5-year at $1.27. We also want to see what institutions are doing with their 82% ownership. They were selling around $1 billion over the last year, but just look at the same period, they bought a significant amount more at $51 billion, and in fact the majority of those buys does come in the most recent quarter, so institutions, whilst only fairly recently, have shown they are incredibly bullish on this company. Jumping into the valuation today, we get to $162, which is the average of these two models. Now, typically on the channel, we run through both models, talking about the inputs and outputs. Today, getting straight to it, $162 as mentioned. We always like to start off with a margin of safety of 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at $146, then we keep going till it's near the current trading price. And in fact, what we can see today, you are getting pretty much a 45% MOS around the $89 mark, which is some significant margin of safety. On top of that, Wall Street give this a $125 price target over the next year, translating to 45% upside. As always though, do give us your thoughts whether or not any of these 6 you do believe are a buy, hold or sell. Before we move to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to undervalued stocks for the month of March. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab another spreadsheet of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the Trade Desk, which is a digital advertising tech company. They provide a demand side platform, DSP, for programmatic ad buying, and they enable advertisers to purchase and manage data-driven ad campaigns across various channels, including display, video, audio, and connected TV. And the platform uses AI and real-time bidding to optimize ad placements for maximum performance. They also serve brand agencies and marketers looking for targeted and measurable advertising solutions. And if we look at the company right now, they are down around 18% over the last year. Year to date, down around 43%, and trading near their 52-week low. Now, if you're a longer term shareholder, you would have outperformed the S&P up 145%, but we can see right now it is quite some way away from its 52-week high of $142, with both Wall Street and Seeking Alpha giving this a buy, although we do note a fairly rare sell from Quant. If we take a look at their earnings over the next 4 quarters, they anticipate 3 of them to be growth, but over the last 4 they do have a 100% track record, and right now, based on their EPS for December 2025, they are trading at a forward valuation of 37, which as we can see, clearly well above the sector median, meaning you are paying a near 200% premium, but compared against their own 5-year forward valuation, they do sit around 56% lower. Again, something that is confirmed no matter what valuation metric you look at. TDD does trade at a substantial premium to the market, but actually at a fairly substantial discount to their own historical data. If we then look at their growth, they do get an A-. Now, revenue year on year, very strong, 26%, forward-looking, 21%, well above the sector comparative at low single digit. So yes, it does deserve its premium, but in terms of their last 5 years, we can see their revenue has sat slightly higher at 31 and 28% respectively. They do also anticipate to grow their EPS fairly strongly, 25% over the next 3 to 5, well above the sector 11, but it is below their own historical figures of 29.4%. If we look at their profitability, equally as strong at an A-. Gross margin 81%, well above the sector at 53%, pretty much in line with their historical figures. Bottom line, very strong, 16% when you consider the sector is just below 4%, and also above their own 5-year at 13.3%. Cash from operations also very strong at $740 million, well above the sector comparative at $355, but also well above their own 5-year at $452 million. In terms of institutions, 68% ownership, around $4 billion worth of sales, but $5.5 billion worth of buys, with also more buying in the most recent quarter than they were selling. So clearly, again, Trade Desk is one that institutions are fairly bullish on. Now, in terms of our intrinsic value, we get to $87, derived from the DCF model, just one model, so we can very quickly show you how we got there. We have the free cash flow year on year. Moving forwards, we have gone for a growth rate of 20%. Now that is below analyst expectations, but as you can see, we have a low, medium and high. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for TDD or any others. But based on 20% and the discount rate, we get the present value of future free cash flows and terminal value add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $87, indicating 32% upside. Now the 15% we will show you for transparency, we do notice around $63, not that far off the current value, meaning right now if you're buying the company at the trading price, already baked into the numbers is 15% growth over the longer term to the free cash flows. Now for those that are a lot more bullish, at 25%, $120, indicating 82% upside, but as we do take the medium rate through today at the 20%, and we do add a margin of safety, we can in fact see at today's value you're pretty much getting a 25% MOS, with Wall Street incredibly bullish, their price target $119, they see 80% upside over the next 12 months, one that they do believe should have some serious consideration in your overall portfolio. As always though, do give us your thoughts below. We then move on to the very well known Uber, the tech company that operates a ride-hailing platform, connecting passengers with drivers through their mobile app. They also provide a food delivery service, Uber Eats, freight logistics, and other mobility services. Using their dynamic pricing and algorithms, Uber optimizes transport efficiency in cities worldwide, and they do also aim to expand into autonomous and electric vehicle adoption for sustainable mobility. Now if we do look at the company, it is in fact down 3% over the last 12 months, year to date up 27%, and longer term shareholders over the last 5 years outperforming the S&P, up 137%, right now trading in the mid to upper end of the 52-week range, and we do see another strong buy from Quant today with a double buy from Seeking Alpha and Wall Street. And one thing we also wanted to highlight for those that didn't know, Bill Ackman just last month revealed he had been building more than a $2 billion stake in the overall company. Looking at the earnings then, over the next 4 quarters, they do anticipate a bit of inconsistency in terms of the growth, but over the last 4, they have outperformed in the most recent 3, 75% track record, with right now the company valued on a forward basis at 31.5. Another company then that does trade at a premium to the overall market, you are paying 27% more, and this is something that is fairly consistent right across all of the valuation metrics. In terms of their growth, they do get an A, now year on year 18%, forward looking over the next 12 months 16, well above the sector comparative at the mid-single digit, but it is below their 5-year historicals of 34 and 27% respectively. They do anticipate though to grow their earnings per share at 36% over the next 3 to 5 years, well above the sector comparative at 11.6. Profitability, we do get an A+ with a gross margin at 33%, above the sector at 32, pretty much in line with their own 5-year of 34, and their bottom line net income coming in at 22%, well above the sector at 6, but also well above their own 5-year where they have been losing money at negative 22%. And in terms of cash from operations, quite a substantial amount, over $7 billion, the sector comparative $369 million, their own 5-year much lower at $286 million. Institutions hold around 80% ownership with $12 billion worth of sales, pretty much double the amount of buying, near $22 billion, and we also see more buying in Q4 than we did no selling. Again, institutions very bullish. Our intrinsic value $104. As you can see, we've gone for a 10% growth rate moving forwards, but we have the low, medium and high at the 8, 10 and 12. Then by using a margin of safety, we do get quite a substantial amount. As we keep going, in fact, at the price right now, you are getting 25% up, in fact, to $78. With Wall Street themselves very bullish, $92 price target, they see upside translating to 23%. We then move on to Taiwan Semiconductor Manufacturing, the world's largest dedicated semiconductor foundry. They manufacture chips for many tech companies, including Apple, Nvidia, and AMD, using their advanced process nodes, and TSMC specializes in high performance and energy efficient semiconductors for smartphones, AI, as well as data centers, and they are a key player in the global semiconductor supply chain. If we look at the company, well, first off, we get a strong buy from Wall Street as well as a buy from Seeking Alpha, trading in the midpoint of the 52-week range. They do pay a yield around 1.4%, and over the last year, up 37%. Year to date, no surprises with tariffs down 7%, but over the last 10 years, massive outperformance of the S&P, up 661%. In terms of earnings, always love to see green across the board, but we also want to highlight over the next 4 quarters, they do anticipate double-digit each one to the EPS, now trading at a forward valuation of just above 20, which, as we can see, in comparison to the sector median, meaning right now you are getting an 11% discount, but on top of that, in comparison to their own 5-year, the company also trades lower at around 12%, something that seems to be fairly consistent amongst the majority of valuation metrics today. We then want to take a look at this valuation model. One thing to note is the blue tunnel does give us the expected fair price. Always good to see this increase over time, something you always want from any company you're invested in. Right now, it sits at the lower end of that blue tunnel. That is an indication right here of potential undervaluation. And as we highlighted already earlier, the company does trade below its own 5-year forward valuation. Again, another undervaluation signal. Growth looking very promising at an A-, year on year 34%, forward looking 25%, well above the sector at the mid-single digit, and also well above their own 5-year at 20 and 16% respectively, with some very strong growth to the EPS anticipated at 33%, well above the sector at 15, but again also well above their own historicals of 18.6. Profitability equally as impressive with an A+, gross margin 56% above the sector at 50 and also above their own 5-year at 54. Bottom line, same thing to be said, 41%, well above the sector at 4, also above their own 5-year at 39.4, showing us efficiencies which we love to see, with a lot of cash generated from operations, 56 billion, sector at 105 million, and their 5-year average also lower at 39.2. Institutional ownership sitting at just above 16%, 17 billion worth of sales, over 20 billion worth of buys, and we also notice in the most recent quarter we get more buying than selling by the institutions. Our intrinsic value also comes to $239, which will show again a nice margin of safety, but you may want a little bit more given the tariff situation that is ongoing. 25%, pretty much where the company sits right now. Wall Street, with their strong buy rating, see this at $245, translating to 36% upside. Is this one you are satisfied with at a 25% MOS? Do you believe with the tariff situation, maybe it will go even lower? We then move on to Constellation Energy, a leading energy company specializing in electricity generation and retail supply. They operate the largest fleet of carbon-free nuclear power plants in the US, along with renewable and natural gas assets, and the company does provide energy solutions to residential, commercial, and industrial customers, focusing on sustainability and clean energy innovation to reduce overall carbon emissions. Now, in terms of the company itself, they are up 30% over the last year, and year to date they're up 2.5%, right now trading at the lower end of the 52-week range, with a double buy from both Seeking Alpha and Wall Street, and a yield payable at 0.7%. In terms of their earnings, over the next 4 quarters, 3 of them expected growth, and we do also note a 75% track record, right now trading at a forward valuation of 24.75. Now, in terms of comparing that against the sector, we can see a 41% premium, but they are pretty much in line with how they have traded over the last 5 years, only a very small 1% difference, but if you do look at different valuation metrics, you may come to a slightly different conclusion. In terms of looking at the blue tunnel, one thing that we do notice, it is at the upper end of that point, so you could argue possible overvaluation, but as always, that is why we never look at any of these models in isolation, and we can in fact see slightly above the 5-year historical forward average. Growth, they do get a B. Now, year on year as well as forward looking does in fact come negative when the sector has been flat over the last 12 months and expected 4% growth over the next year. We can see over the last 5 years, they have been up 10% in terms of the revenue, and the same comparison forward looking down around 1%. In terms of the EPS, it is anticipated to grow, although only around 2%, which is lower, as we can in fact note, than the sector at 6.73. And then in terms of the profitability, they do get a B-, gross margin 25%. That is significantly lower than the sector at 46, but a lot higher than the last 5 years at 14. And in terms of their bottom line net income, 16%, well above the sector at 12, but also well above their own 5-year at 5.1. Cash from operations at the moment is negative, something to keep an eye on, negative 2.5 billion in comparison to the sector at 1.3 billion, and we also notice over the last 5 years it has been even lower at negative 3.4. Also have to bear in mind this is an energy company, and we do notice institutional ownership sitting at 82%, 8.5 billion worth of sales, just over 9 billion worth of buys, and the same trend in the most recent quarter. Overall in 2024 and in the most recent quarter, institutions have been buying a little bit more than they have in fact been selling. Now, in terms of our intrinsic value today, we get to $198, which is actually slightly lower than the current price, but it does depend whether or not you would include the multiples valuation. One that could be argued the company does trade above, might be seen as a higher quality than others in the sector, and then it would come to $220. Regardless, right now we do see this company trading near its fair price, or in fact slightly above, and therefore there is no margin of safety. If you did want 10% at around the intrinsic price, including the multiples valuation, it would be around $178. One thing though we do want to point out, Wall Street are very bullish. They do see a lot of upside over the next year, $320 translating to 42%, and it would be interesting to see whether or not you agree with that, or you do believe this company is now trading around its own fair value. Again, as always, sometimes we do like to pay a little bit of a premium, or in fact a fair value of a company, if we do believe over the longer term it is a strong company, high quality, and will outperform the S&P. As always, we can never time the market. We then move on to MongoDB, the software company that develops and manages a popular database designed for scalability, flexibility, as well as handling large volumes of unstructured data. And MongoDB Atlas is a cloud-based database service enabling businesses to deploy and manage data efficiently. The company serves developers and enterprises in industries like finance, e-commerce, as well as technology. Now, we do get this company down around 18% right now, as they did release their earnings after the market closed yesterday, where they did lower their guidance, something analysts did not like to see. They're down 35% over the last year. Year to date, they are up, although these gains will be wiped once the market opens. And over the last 5 years, shareholders would be up around 66%. Right now, in fact, when the market opens, it will be trading at its 52-week low, with a double buy from both Seeking Alpha as well as Wall Street. Now, we do have their earnings over the next 4 quarters. They anticipate 2 of them to be growth, with the last 4 being beats, 100% track record. And whilst we get the EPS estimate for January 2026, given the forward valuation of 84, one thing we have to bear in mind though, as the market opens, the forward P will come down. Having said that, regardless, it is trading at a premium to the overall sector, meaning right now you're paying 265%. It will, as we said, get lower after the market open, but nonetheless, a premium will still be there. In terms of growth, they get an A-. Now, year on year, 21%, forward-looking, 22%, well above the sector comparative at the mid-single digit, but lower than the 5-year on both accounts at 41 and 32% respectively. And then we get to the EPS, which is anticipated to grow at 18% over the next 3 to 5, which is above the sector at 14.6. Profitability, we get a C+. Now, gross margin, 74%. Again, above the sector at 50, above their own 5-year at 72. Bottom line, at the moment, negative 11%. Sector, positive 4%. Over the last 5 years, negative 30. So whilst they are losing money, they are improving, and hopefully we will get to see this turn positive very, very soon. They do ultimately generate positive cash from operations at $155 million, which is above the sector comparative at $102, and also above their own 5-year at $21.5. If we look at the institutions, near 90% ownership with $57 billion worth of sales, very limited in comparison to buys at 2.9, and we also noticed the large chunk of those sold was in the most recent quarter at Q4, $56 billion. So unlike the other ones, you could argue perhaps maybe institutions are bearish. Having said that, straight away we do see that Wall Street and their forecasts are giving this company 71% upside. They see this at $373 over the next 12 months, and we have this intrinsic price at $287. We can in fact show you how we got to this price. We have the expected 2025 free cash flow from management at $534 million, and we can see the growth rate at 14% is one we have gone for, with a low, medium and high respectively. At the 14%, 287, at 12, 17% upside at 1648. And when we do apply our MOS at 10%, a buy at 258, at 20% at 229, and at 25%, not quite there yet, not far off, but for MDB, a near 25% MOS, with, as we said, Wall Street incredibly bullish. They see 71% upside over the next year, even after the lower guidance. As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon, where we do run through our weekly buys and sells, which we have been doing a lot more buying given the massive drop we have seen in the market over the last week. But as always, have a great day, and we'll see you all on the next one.